A quick update from the United States now, where inflation fell to 2.5% in August, setting the stage for the Federal Reserve to start cutting interest rates gradually at its meeting next week. The latest annual consumer price index compared with July's 2.9% pace and was marginally below the estimate of 2.6% from economists polled by Reuters. But the inflation data marks one of the last major economic releases ahead of the Fed's meeting on the 18th of September and paves the way for an expected quarter-point cut to interest rates, which are currently at a 23-year high of 5.25 to 5.5%. For further clarity, we have with us senior finance professional and business economist Sanchita Mukherjee on the broadcast. Thank you so much, as always, for making time for us. Ms. Mukherjee, does this latest report show that the US is turning the page on inflation?
Yes, absolutely. Thank you so much for having me here. And this definitely shows that inflation, although it's not reaching the targeted 2%, however, it has come down in terms of groceries and food prices and oil prices. It has come down as a reading. So this might definitely prompt the Fed to look at a 25 bip rate cut on 17th, 18th when they meet up. However, there is another component of the inflation, which is known as the core PCE, which is essentially reflecting that the housing costs and the airline costs have increased, cost of rent, which might make the Federal Reserve reconsider going for a more aggressive cut beyond 25 bips. That is a 50 bips. That may not happen because they might look at it in a more gradual manner, given that the housing price cost and the airline costs have increased.
In fact, details in the report showed the somewhat stickier monthly inflation, which is seen as likely to make the Fed proceed cautiously.
Yes, that's right. That's exactly what I was saying. So they would be cautious. Most economists on the are of the forecast that it will be a 25 bips rate cut and not a very aggressive 50 bips rate cut because there are certain items in the consumer price index, for example, the rent, the housing cost and the airline tickets, which seem to be a little on the unexpectedly larger side. Having said that, the unemployment numbers have come down considerably from expectations, and the fact remains that the economy, whilst it's doing all right, it seems to be having a soft landing on the recession, on the recessionary fears, right? So a 25th bips point is most likely what the Federal Reserve would like to consider. A 50 bips rate cut would actually indicate that the recession is a hard landing. In fact, it would actually assume that the recession would be in larger proportions. So that might also create a bit of a negative impact on the markets.
In fact, some point out that this inflation report left markets anticipating a smaller cut, as you've also highlighted, but it disappointed some investors and triggered a temporary sell-off in stocks as well.
Not really. I think the 25 bips point cut has more or less been factored in global markets, in US markets and in Indian markets. So it's more in lines with expectation and anticipation of a 25 bips cut at this point in time. In fact, what remains to be seen is whether the 50 bips rate cut, if at all, if that happens, which is aggressive, whether it will be viewed positively by the market or negatively, because traditionally rate cuts have been viewed as positive for the equity markets, for global markets, in fact. But a 50 bips aggressive rate cut would indicate that the recessionary fears are a bit heightened and that all is not okay. So in which case it might actually be viewed negatively by the markets.
Well, as always, Ms. Mukherjee, thank you so much for joining us on NDTV and making time for us.